This lesson is going to cover candlestick analysis. So let's talk about the context of candlesticks first of all. Individual candles represent the high, low, and the open and the close of any particular time frame. So if you have a daily candlestick, whenever it closes and moves on to the next day, you can see the previous day's open, the lowest point it reached, the highest point it reached, and the price it closed at. That's essentially what a candlestick is. So analyzing candlesticks, I do use it in certain instances, which I'm going to show in this lesson, but I want to say very, very clearly, candlesticks are the lowest form of analysis, right? They're not magic. They are definitely not a trade thesis. They are a supplement to a system. And the best way to use them is for entries and exits. And I'll give an example of that whenever we do the first two, bullish and bearish engulfing. But I wanted to make that clear at the very start. If you're analyzing price action, entire movements, swing high to swing low, or full structures like in Wyckoff, you're looking at a vast amount of data that encompasses a long period of time. To then just look at a single candlestick and make major trade decisions based upon that, it's foolish. But with that being said, let's get into the candlestick analysis. So, the first two, and I'm showing the ones that I personally have used, tested, and find to be useful, and the most useful of all candlesticks are the engulfing ones. So you have a bullish engulfing and a bearish engulfing. A bullish engulfing candle, as you can see, is one in which it's a two candlestick pattern, technically. The first candle will be a short red body that will be completely engulfed by the next candle, which is a large green candle. Engulfing means it covers the entire space. So the body of the second candle covers the entire body of the first candle, and, importantly, it closes outside of the body. So in the bullish example, it will open, it may or may not wick down, but it will cover the entire body of the previous red candle and close above the previous red candle's high. In a bearish engulfing, it's the exact same thing, just in reverse. You have a green candle, and then the very next candle is a red candle that fully engulfs the green one, goes all the way down through it, and the body of the red candle closes below the body of the green candle. Bearish engulfing tends to happen towards the end of an uptrend, and a bullish engulfing tends to happen towards the end of a downtrend. They both signify a slowdown of the price movement and a struggle between the bulls and bears. It's a sign of an impending reversal, and it gives you an idea of where the path of least resistance is. You know from previous lessons about the importance of the path of least resistance. If a bullish engulfing candle occurs, it shows that whoever tried to sell on the previous candle has immediately been rejected, and it indicates price is likely to go higher. On a bearish, it indicates that bulls tried to push the market further and they got rejected immediately, showing that the path of least resistance is probably to the downside. These are very useful candles for reversal patterns. Now, to touch on about using them solely as a trader or to make trades, I would never use them by themselves to just enter or exit. What you can use them for is early warning sign or indication to get out of your trade if you're on the wrong side, or confluence for your existing trade. So, let's take an example. Imagine a bullish engulfing candle that you are already in a long from lower. If you're in a long from lower and then you see this bullish engulfing, you would know to sit tight, continuation on your long, that's fine. The bullish engulfing is like giving you more confidence in your upside movement. Similarly, if you went short on this candle or in this candle, and then you see the bullish engulfing, that should be a clear sign to cut and get out. The market is telling you that you are likely wrong. So the best use of engulfings are for confirming your trade thesis to continue, or giving you an early warning sign to get out. You can, of course, then look for trades in the opposite direction if other factors present. Moving on, let's look at a hammer and a hanging man. So, a hammer is a bullish candlestick. It's a candlestick that forms with a short body and a long lower wick, and it's normally found at the bottom of a downtrend. A hammer will tell you that there was selling pressure, but because it closed with little to no upper wick and a body up the top, it means that whatever selling went on earlier in the candle has been reversed by the bulls and it's closed strong. There's potentially a lot of people trapped below there in that wick. A lot of traders are offside if they went short, and that shows, usually, strong reversal for the bulls. They normally appear at the bottom of the market, so reversal, candle. They can also appear mid-trend. They don't always have to be at the exact bottom. And, this is important with hammers, they can be green or red. So this one on the screen is a red one, which actually turned out to be very bullish. But often, if the hammer closes green, it's stronger than if the hammer closes red. That's just a rule of thumb. It should be pretty obvious. If it closed green, that means it closed at the highest point it could have for that candle. If it closed red, it means it could have closed a bit higher. It could have went green, so why did it not go green? Maybe it's not as strong as a green hammer would be. So Both are bullish, but a green hammer generally stronger than a red. Let's look at a hanging man, a bearish candlestick. This is the bearish equivalent of the hammer. So it's just inversed. It has the same shape, but it forms generally at a top or at the end of an uptrend. Again, think about what the candle means. It indicates that at some point during the period, whether it's a day or an hour or a week, whatever your candlestick period is, there was a significant sell-off. But buyers pushed it back up to the close. So we sold off on this candle. We then pushed all the way back up and closed higher, closed higher than we could have. But the warning sign that it gives you is that large sell-off is quite often an indication that bulls are losing control of the market. Now, the same thing applies here. A green or red hanging man can exist. And if it closes green, it has a stronger chance to go higher. So in this particular example, the red hanging man, that's textbook reversal. That red hanging man would be bearish. That would indicate a high probability reversal, as it does in that particular example. Let's look at two more. We have a bullish inverse hammer and a bearish shooting star. I'm showing these together, again, because they are the same candlestick, just at one is bullish, one is bearish, inverted. So the inverse hammer is the same, roughly, as the hammer, but because it's called inverse, it means that the upper wick is long and the lower wick is short. Okay, so it indicates strong buying pressure because there's an upper wick, a long upper wick, but it was followed by selling pressure. So sellers tried to come in, but most importantly, that selling pressure was not strong enough to drive the price down. It was not strong enough to make...
Hi! I just can't stop playing Monopoly Go.
the market go lower, and it closed with a candle body near the low of the candle. So the inverse hammer suggests that soon bulls will have control of the market and that there should be solid support below. So it's not as strong as a hammer, obviously, but it shows absorption. It shows the bulls are willing to support price, and soon we could see a reversal. Shooting star, like I said, is the same shape as the inverted hammer, but it's formed in an uptrend. And again, it has a small lower body and a long upper wick. And usually the market will gap slightly higher on opening or push slightly higher and rally and then get really slammed down. So when I say that about gapping, if you look at it, this is like if you're looking for the very, very best type of shooting star pattern. Whenever the previous candle closes and the next one opens, if it pushes straight up with no lower wick and then gets sold back down and closes like this, it's very highly probable that bears are in control and that the market is going to go down. Because when it pushes up, no testing lower, gets rejected, it leaves lots of room below that has been untested, and it really puts bulls in a vulnerable position. So the bearish shooting star is a really nice topping candle, a really good clear warning sign that if you're in a long, get out, or if you're aiming to line up shorts, you have some confluence. Finally, we'll talk about doji candle. Dojis are very common, and I find them to be quite useful, but they're a bit different to the previous ones. The previous candlesticks that we've talked about generally are all for reversals, is where they're best used. The doji is not a reversal candle or a continuation candle. It can be both, depending on context. So, what is a doji? When the open and close of the candle are almost the same point, almost the exact same price, and it looks kind of like a plus, the candlestick looks like a plus sign, that's what a doji is, right? If you have almost no candle body with wicks either side, that's a doji. So what does it actually mean? It signals that the market's confused, right? The market does not know if it wants to go up or down on whatever time frame you're seeing it on. It signals indecision. The doji signals a struggle between the bulls and the bears. And at the end of that struggle, there's not really any clear winner. So by that very definition, it's a neutral candlestick. But when you give context to it, you can have clues. So if you see an indecisive neutral candle after an extended rally, after an extended uptrend, you can say that's a sign of a probable reversal. Because we've already been going up for a lot of time, if it then puts in an indecisive doji, we could be heading lower. Look at the reversal example, and you'll see two really strong green candles before it. So we're in an uptrend and we're seeing strong trending candles. Then we have a doji. And when we have a doji and it doesn't act like the strong trend candles from before, and we've been in an uptrend, you can say high probability that we're going to have a reversal on that time frame. As for continuation, that would be more where we are in the middle of a trend. At the very, very start, of course, it would be the same as the one I just showed. It would be more of a reversal. But if you're mid-trend, meaning you've trended up for one leg, typically trends have 2, 3, sometimes even 4 legs, where they go up, consolidate, up, or down, consolidate, down, consolidate, down. If you've done one leg up and you're consolidating and you see a doji candle, it is likely going to be continuation because the market has already shown a bias towards wanting to go up, and then it's sitting and it puts in a doji. That means traders can't decide what way it's going to go, and if we can break above that, it should continue on that time frame, remember. And of course, the same happens in reverse on a downtrend. Anytime you see the doji, just know it's neutral. It means that traders are indecisive and you have to apply context. You can never look at a doji and say, that's bullish, that's bearish. As soon as you see a doji, you want to think, what does the bigger picture tell me? Let's zoom out and look at the last 100 candlesticks or 50 candlesticks, not just this one. Okay, we're in an uptrend and we see a doji, might be a reversal. We're in a significant downtrend, we see a doji, might be a reversal. Bulls might be getting back control. We're not really trending, we're sort of halfway in between, we see a doji. Okay, it could be continuation. And that's the way you want to view it. So focus on that one as a neutral sign. All the others, you do have a bias with them. They are either bullish or bearish. They are not ambiguous. There's not really any subjectivity to them. So that is candlestick. They are the main ones that I use. They're the ones I find useful. They're the ones I've tested. There are many more. You're more than welcome to research them yourself. But I find these ones are really all you need because you should not be trading solely off of candlesticks. You should be using them in combination with other factors. There will be lessons on multiple candlestick patterns, so that happen together, because it takes one candlestick to build into a full pattern. So if you look at something like a bull flag, a very common pattern you'll all have heard of, that's just a collection of candlesticks. So this lesson was on single candlesticks and how they form, but in future lessons, you will see about multiple candlesticks, what they mean, and how you can trade them.